The Bank of England has made a significant move. They've cut interest rates. This decision is aimed at stimulating the economy and providing relief to borrowers. This is big news for everyone in the UK. Whether you're a homeowner, a business owner, or just someone with a savings account, this change will impact you. The rate is now down by 0.25%. This might seem like a small change, but it can have significant effects on the economy. It now sits at 4.5%. This new rate is designed to encourage borrowing and spending. That's the lowest it's been in over a year and a half. This is a strategic move to boost economic activity. But what does it all mean for you? Let's break it down. Lower interest rates can mean lower mortgage payments and cheaper loans. This cut is a big deal. It can also affect your savings, as lower rates might mean lower returns on savings accounts. It affects everything from mortgages to savings accounts. Businesses might also find it cheaper to borrow money for expansion. The Bank of England doesn't make these decisions lightly. They consider various economic indicators before making such a move. So, why have they done it now? The current economic climate and the need to stimulate growth are key factors. Read on to find out. We'll explore the reasons behind this decision and its potential impact. This is a complex issue with far-reaching implications. It affects not just individuals but the entire economy. But don't worry, I'm here to guide you through it. We'll break down the details and make it easy to understand. By the end of this, you'll understand exactly what this interest rate cut means for you and your pocket. Stay tuned. The Bank of England's main job is to keep the economy stable. This involves a delicate balancing act that requires constant vigilance and timely interventions. They do this by controlling inflation, which is the rate at which prices for goods and services rise, and by supporting economic growth to ensure a healthy economy. Recently, there have been growing concerns about the UK economy slowing down, with indicators showing a downward trend in growth. To counter this slowdown, the bank has decided to cut interest rates, a move aimed at stimulating economic activity. The idea is that lower rates will encourage people to borrow and spend more, making it cheaper to take out loans and mortgages. This, in turn, can boost economic activity by increasing consumer spending and business investments. The bank is walking a tightrope, trying to stimulate the economy without letting inflation get out of control. They need to balance stimulating the economy with keeping inflation under control, a challenging task in uncertain times. Governor Andrew Bailey, the head of the Bank of England, said this cut is a positive step towards economic recovery. But he stressed that the bank is keeping a close eye on both the UK and global economies, ready to make further adjustments if necessary. They're ready to act if needed, ensuring that the economy remains on a stable path. Chancellor Rachel Reeves has also weighed in on the situation, offering her perspective on the economic challenges ahead. She's expressed concern about the economy's direction, highlighting the need for coordinated efforts to address these issues. The government, she says, is committed to boosting growth and stability, working alongside the Bank of England to navigate these turbulent times. One of the most immediate effects of the interest rate cut will be felt by mortgage holders. This change can have a significant impact on your monthly budget and overall financial planning. If you have a tracker mortgage, your monthly payments are likely to go down. Tracker mortgages are designed to follow the Bank of England's base rate, so any reduction in this rate is directly passed on to you. This is because tracker mortgages are directly linked to the Bank of England's interest rate. As the base rate decreases, so does the interest on your mortgage, leading to lower monthly payments. For those with fixed-rate mortgages, the impact will depend on when your fixed term ends. If your fixed term is ending soon, you might want to start exploring new mortgage deals to take advantage of the lower rates. If you're nearing the end of your fixed term, it might be a good time to start looking for a new deal. Consulting with a financial advisor can help you find the best options available. Lower interest rates could mean lower monthly payments for you. This can free up some of your income for other expenses or savings. However, it's not all good news. While mortgage holders may benefit, savers could face challenges. Savers might see lower returns on their savings accounts. This is because banks typically lower interest rates on savings accounts when the Bank of England rate goes down. It's important to review your financial strategy in light of these changes. So, what does the future hold? Many economists believe this rate cut is just the beginning. They predict further cuts throughout 2025. Francis Haka, an economist at Santander UK, is one of them. However, it's important to remember that economic predictions are not guarantees. The actual path of interest rates will depend on a complex interplay of factors both in the UK and globally. My advice? If you're concerned about the impact of interest rates on your personal finances, talk to a financial advisor. They can help you navigate these uncertain times and make informed decisions.